Good morning, everyone, and welcome to today's webinar. Today's topic is new compliance requirements for mortgage holders, the CFPB's proposed Regulation X amendments. Before we get started, I would like to take a moment to go over a few housekeeping items. My name is Jackie Banis, and I'm today's webinar organizer. As a reminder, this is an interactive session, so please submit your questions through the question button in the control panel. Questions will be addressed at the conclusion of the presentation. This webinar is also being recorded. At the conclusion of today's session, a link to the recording and a copy of all slides will be sent to attendees. Lastly, there will be a short survey on your screen at the conclusion of the event. Please take the survey and share your feedback. We greatly appreciate hearing your opinions on our webinars. Now, for the moment everyone's been waiting for, I would like to introduce today's presenter, Larry Rothenberg. Larry assists banks, credit unions, and mortgage servicers with defaulted real estate transaction and the recovery of mortgage secured debt. He typically handles residential and commercial foreclosures, evictions, and title insurance issues. Whether his clients are looking for alternatives to foreclosure or need to pursue legal action, Larry seeks to obtain maximum results in the shortest amount of time. He has been recognized in 13 editions of Ohio Super Lawyers and is AV preeminent rated by Martindale-Hubbell, its highest available rating for legal ability and professional ethics. So now, without further ado, I will hand it over to Larry.
Thank you, Jackie. First, a few words about our law firm, Weltman, Weinberg & Reese. We specialize in creditors' rights. We're nationally recognized for that. And we represent all kinds of creditors, including some of the largest financial institutions in the country. Our specialties are in creditor representation in bankruptcy, consumer and commercial collections, litigation, and my area, real estate foreclosures, loss mitigation, and evictions. What we're going to review today will include the following. First, we'll review RESPA and Regulation X in general, what the pandemic has done to the industry and has led to these proposed amendments by the Consumer Financial Protection Bureau, forbearances and how the current economy is performing, loss mitigation options, and then we'll get to the CFPB's proposed amendments and how they might affect you. And finally, the American Legal and Financial Network's comments to the CFPB about the proposed amendments in an attempt to get the CFPB to make some revisions to their final amendments as they're enacted. In a nutshell, the proposed new requirements will cover the following. It will require live contact with the borrower to provide information, loss mitigation requirements, some new loan modification requirements, what the CFPB calls its pre-foreclosure review rule, which will likely delay the commencement of your foreclosure. The CFPB plans for more aggressive enforcement unit. They've stated that publicly. There's a new director now under the new administration. He has stated publicly that he plans to be aggressive in enforcement, much more than under the prior administration. And that causes the worry about regulation by enforcement, which I'll talk to a little bit later. Proactive communication by the servicer to the borrower to educate the borrower more fully on their options if they have financial hardship. And finally, the necessity to document your policies, your procedures, and your training of your staff, in addition to documenting what is done on each individual loan file. So we'll start with a little review about RESPA and Regulation X. RESPA was enacted in 1974, the Real Estate Settlement Procedures Act of 1974. It does apply to almost every loan, and it applies to lenders, mortgage brokers, or servicers of home loans and requires them to provide borrowers with pertinent and timely disclosures regarding real estate transactions, settlement services, and consumer protection laws. So basically, these entities, the lenders, the mortgage brokers, and the servicers are required to educate the borrowers. And it also prohibits specific practices such as kickbacks, and it places limitations on the use of escrow accounts. RESPA was amended in 1990 to require detailed disclosures about the transfer, sale, or assignment of mortgage servicing. So if you'll remember, in the 1990s, securitization of loan packaging became prevalent, and pools of loans were being transferred rapidly from one servicer to another, and it was difficult for the borrower to keep up with who they needed to communicate with. It even became difficult for the servicer to know who the owner of the loan was at the time. And so in 1990, there was additional regulation to try to resolve those problems. The 1990 amendments also required disclosures for escrow accounts at closing and then annually, the itemization of the charges to be paid by the borrower and what is to be paid out of the escrow account by the servicer. Then in 1992, there was another amendment to cover subordinate liens. In 2008, HUD got into the act and made some changes, including its requirement for a good faith estimate form and a revised HUD 1 settlement statement. And you'll recall the real estate meltdown, 2007 until, let's say, 2010 at least, that led to the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act. And that granted rulemaking and enforcement authority under RESPA to the CFPB. In 2013, the CFPB issued a final rule to amend Regulation X. So they called it a final rule. They actually call every amendment they make their final rule, but this was a final rule in 2013 about servicing transfer notice requirements and new requirements related to borrowers' error resolution requests and information requests. There were also new provisions for escrow payments, forced placed insurance, general servicing policies, etc., and continuity of contact and loss mitigation regulations started to become more detailed. In the 2013 and the 2014 amendments, again, the CFPB issued what it called its final rules to further amend Regulation X. And these included loss mitigation requirements, notices of error, and information requests. And then in 2015, we learned a new word, TRID. That was the Truth in Lending Act and RESPA Integrated Disclosure Rule, and is applicable to the closed-end mortgage loans that are covered by that amendment. Then in 2020, COVID-19 hit us. The national emergency was declared in March of 2020, and the CFPB issued its interim, again, final rule in June, amending Regulation X, and that amendment allowed servicers to allow some loss mitigation options based on an incomplete loss mitigation application. Unlike the prior foreclosure crisis in 2007 to 2010, the agencies, Fannie Mae, Freddie Mac, FHA, VA, mandated forbearance. That was something new. In March of 2020, Congress enacted the CARES Act. So we remember when that came into existence, if you attended my webinar at that time, that act covers only federally backed mortgages, and it provided that a borrower may request forbearance merely by saying they've been financially harmed by the coronavirus. And they could then request a 180-day forbearance and then a second forbearance up to an additional 180 days. That's a total of a year. And finally, in this past February 2021, the FHA and the VA expanded their forbearance programs to add an additional 6 months. So now we're talking about a maximum of 18 months for those loans. 3 days ago, June 21st, Maxine Waters, the chairperson of the Financial Services Committee in Congress, wrote a letter asking the federal agencies to extend their moratoriums further to cover any gap until the CFPB, or at least until the CFPB enacts these amendments. So at the moment, these amendments are still proposed, I expect them to be issued anytime between today and June 30th. Let's run through some statistics that I think you might find interesting about borrowers who have a forbearance agreement under COVID-19. 6.9 million of them since the CARES Act came into existence in March of 2020. 2.18 million are active, which is down from 2.7 million in February. 830,000 are scheduled to expire this month. That's roughly 1 year from the CFPB's prior announcement, and another 800,000 in September or October, which would coincide with the 18-month period from March of 2020. More than 98% of borrowers over 90 days delinquent have received forbearance or are actively in loss mitigation. More than 50% of the borrowers who are granted forbearance have begun reperforming under the loan's original terms. So more than 50%, that means probably close to 50% are not. In the pandemic's early months, this is March through June of 2020, 40% of those who got into forbearance continued making their mortgage payments. But as of January of 2021, only 10% were doing that. A few more statistics about borrowers who have exited forbearance during the past year. 27%, a little over 20% are in default. 24% continued making their monthly payments during forbearance. A little over 15% did not make all their monthly payments during forbearance and have no loss mitigation plan in place. So that doesn't sound too good in terms of likely foreclosures for those people. Almost 14% became fully reinstated. A little over 10% entered into a loan modification agreement or a trial loan modification. 7% paid their loan off through finance, refinance, or a sale, and 1.5% entered into a repayment plan, a short sale, or a deed in lieu after they exited their forbearance agreement. Those were borrowers who were in forbearance. For those who were not in forbearance, as of last January, this past January, 90-day or longer delinquencies were 5 times their pre-pandemic levels. 207,000 seriously delinquent loans were delinquent before the pandemic started and are not in forbearance. And just yesterday, Black Knight reported that 1.7 million first lien mortgages remain seriously delinquent, and that's about 1.25 million more than prior to the pandemic. So I run through these statistics because the CFPB uses these numbers to try to justify the need for additional regulation, because the CFPB argues that based on these numbers, we are probably going to have a wave of foreclosures. The employment picture, as you probably know, has picked up. So for the week ending June 5th, the seasonally adjusted initial unemployment claims were 376,000. That's a decrease from the previous week of 9,000, and it's the lowest level for initial claims since last March. Let's run through the options available to borrowers who are coming out of forbearance. Obviously, we have and continue to have historically low interest rates, so it's much easier for them to refinance their loans. Reinstatement is always the best option for the servicer. Repayment plans can be available. Deferment of missed payments without incurring additional interest. Loan modification agreements, deed in lieu. And right now we are experiencing a rising real estate market. So many sellers are finding buyers for more than their asking prices, which means a short sale or even a sale for payment in full can become much more likely than would have been possible, say, last year. So again, the CFPB is emphasizing in its report that there's a heightened risk of foreclosures. Those loans that are in forbearance that are coming to an end, that did not pause the delinquency may already be over 120 days delinquent, and that forebodes for a quick foreclosure as soon as the forbearance might end. Keep in mind that the CFPB's proposed amendments will only cover principal residences. So if the loan is secured by a property that is not a principal residence, these amendments that I'm going to discuss now won't apply. And also, if the property, whatever the property might be, including the former principal residence, became abandoned and is abandoned, it has never been covered by any of the moratoriums. Does the CFPB have legal authority to do what it proposes? Well, yes, it does under RESPA and the Dodd-Frank Act. They both authorize making rules and regulations to accomplish RESPA's purpose. But this time, these amendments are going to affect private lenders, unlike the CARES Act, which was enacted last March that only applied to federally related loans. These amendments will affect private lenders as well. So someone will probably bring a test case to challenge the constitutionality of the amendments. Quickly, we'll review what is currently in effect. This is prior to any new amendments that are going to come about. So the objective of the current regulations are to ensure that the borrowers are educated and have an opportunity to avoid foreclosure through an alternative. So the servicers are expected to provide them with that information. Servicers should be making good faith efforts by the 36th day of delinquency, and again by 36 days after each payment due date to contact the borrower and explain or try to help the borrower understand their situation by informing the borrower of those loss mitigation options. And I'll use the word generally. That's what the current regulation requires. And then I'll get a little more in depth about what that might mean when we get to the amendments in just 1 minute. The CFPB, in their proposed amendments, define a COVID-19 related hardship as being a financial hardship due directly or indirectly to the COVID-19 emergency. Now, to me, when they use the word indirectly, almost anybody can claim that their financial hardship is indirectly caused, or at least indirectly caused, by the COVID-19 emergency. So I would be very careful in trying to draw a line between one borrower's type of financial hardship and another as to whether it's related to the COVID-19 emergency. I would assume in almost every case that it can be. There are exceptions. For example, if your borrower got put in jail or something like that, that's totally unrelated to COVID-19. Now we come to what are these proposed requirements. So the CFPB issued its publication of its proposed requirements and actually asked the industry participants for comments before they enact these proposed requirements. It was a total of about 46,000 words. So they gave us some reading to do, and I'm trying to boil it down into a short webinar here so you don't have to read 46,000 words. First, the CFPB wants early intervention. That's contacting your borrower. And this will last for 1 year from the amendment's effective date. You have borrowers that are either in forbearance or not in forbearance. So those borrowers who are not in forbearance, you're going to be required to ask them whether they are experiencing a COVID-19 related hardship. And if so, you are to list and briefly describe available forbearance programs and actions the borrower must take to be evaluated. Briefly describe, what does that mean? That's not well defined. And so I would, if I were you, you should err on the side of caution and describe more than briefly what your available forbearance programs might be and what actions the borrower must take to be evaluated. Then you have borrowers who are currently in forbearance. For them, You are to provide them with specific information about their current forbearance program, such as when it's scheduled to expire and what the borrower is going to be expected to do when the program expires. And again, list and briefly describe, again, err on the side of caution there, briefly describe post-forbearance loss mitigation options and actions the borrower must take to be evaluated. Regulations for loss mitigation procedures will require that you receive a loss mitigation application and evaluate it. The proposed amendments use the word anti-evasion. And what they mean there is you are not to guide the borrower into accepting a loan modification agreement, for example, without explaining to them all of their options for loss mitigation. You will be required to explain their loss mitigation options, their loan modification options. You will not be permitted to charge interest on the payments that are being skipped under a forbearance agreement. You will not be allowed to charge late charges, penalties, or stop payment fees. And you can extend the term under a loan modification agreement for up to 480 months. If you engage in a loss mitigation agreement, it must end any pre-existing delinquency. So for example, there will be no partial loan modification agreement with the existing or with the delinquency continuing to exist. It must end any pre-existing delinquency. You must allow ample time for the application and for the borrower to submit their application and to review any loss mitigation options. So what is the definition of ample time? Again, the CFPB does not define that clearly. And so again, you should err on the side of caution and allow more than ample time for your borrower to submit an application and to review their options. The CFPB's amendments will require reasonable diligence. And here the CFPB does give some definition. So for example, if a loss mitigation application is received at least 45 days before the foreclosure sale, you better be sure to process that and give the borrower the response. And if the response is that they're accepted, their application is being accepted and whether it's for forbearance or repayment plan or what have you, that it's processed and the foreclosure sale will be withdrawn. Also, if the borrower enters into a trial loan modification agreement and then fails to pre-fund it, again, you'll be required to use reasonable diligence to contact that borrower, explain to them the situation and what their options are at that point. And then finally, if the borrower contacts you to request further assistance, reasonable diligence again is required to explain to the borrower, make the borrower understand their options, and give them time to engage in those options. You will be permitted to have the borrower submit a single application for any loss mitigation option, whether it's for a repayment plan, forbearance, loan modification, etc. If your borrower is experiencing a COVID-19 related hardship, and again, that means directly or indirectly, so almost everyone can claim that, a loan modification must be available to them. Servicers will be permitted to offer a loan modification based on an incomplete application, unlike previously. Now, the CFPB states in its amendment that a borrower may not be harmed by accepting loan modification instead of applying for loss mitigation. So what does this mean? The borrower may not be harmed. What does harm mean? Well, comparing a loan modification to another form of loss mitigation, it might be a matter of opinion as to whether the loan modification is more harmful to the borrower than the other form of loss mitigation. Once again, err on the side of caution. You should proceed as if the CFPB is looking over your shoulder and they are out to get you. Loan modification may not require an increased principal and interest, and it may not extend the term by more than 480 months from the effective date of the loan modification agreement. Any payments that are delayed in the loan modification cannot be charged for additional interest, and you cannot charge a fee for a loan modification agreement. So that means you cannot pass on to your borrower that qualifies under these amendments a fee that your attorney might charge for preparing the loan modification agreement for you, or your own fee for agreeing to a loan modification agreement or processing it. If you enter into a loan modification agreement, you must waive all existing late charges, penalties, stop payment fees, etc. So the borrower who is already delinquent and has incurred those late charges and penalties, etc., those get wiped out. They'll have a clean slate with your loan modification. They can be charged late charges on future payments under the loan modification agreement, but not those that are already existing. And as I said earlier, a loan modification agreement must end all pre-existing delinquency. No partial loan modifications. The FHA has its own set of home retention options. These go beyond the scope of what we're discussing today, but just so you're aware, the FHA has options on FHA loans, including the standalone partial claim, the COVID-19 owner-occupant loan modification, the combination partial claim and loan modification, and its HAMP program. Also for non-occupants, it has a loan modification program as well that can modify the rate and the term. That's for the FHA loans. The CFPB's amendments have something they call their pre-foreclosure review rule. So we already know that the CFPB currently has in effect its 120-day rule. No foreclosure may be commenced until the loan is at least 120 days delinquent. Under this pre-foreclosure review rule that I expect the CFPB will enact, the 120 days will not be based on when the first delinquency occurred if the borrower, for example, went into forbearance for a period. So for example, if your borrower was 60 days delinquent and last June they entered into a forbearance agreement with you where the borrower had 180 days or 360 days to be in forbearance. When they come out of forbearance, the loan is not now the 60 days that they were already delinquent plus the time that has passed since then. They're only 60 days delinquent when they come out of forbearance. You have to wait another 60 days for them to be considered 120 days delinquent before you can commence your foreclosure. The CFPB is also very concerned about what it calls the dual tracking program. So here you're negotiating with your borrower for loss mitigation, and at the same time you're commencing the foreclosure and incurring foreclosure costs. The CFPB wants you to avoid incurring those foreclosure costs before the borrower has had a meaningful opportunity to submit a loss mitigation application. The amendments will impose a new moratorium of sorts on a primary residence until after December 31st of 2021, regardless of the length of delinquency, unless it qualifies for an exemption. So let's look at the exemptions from that moratorium. So first, if the servicer completed a loss mitigation review and the borrower is not eligible for any loss mitigation and you've documented your system in that regard, you're not bound by that moratorium. Also, if you've reached out to your borrower and they haven't responded despite your reasonable diligence, and here the CFPB at least gives some guidance on what it means by reasonable diligence, a minimum of 4 phone calls to the last known number at different times of day. So document your system as to what time of day you're making your calls. Make at least 4 calls to attempt to reach a borrower, and document, as I say, that you made the call and the last known number and different times of day, and send 2 written notices to the last known address, one by certified or express mail or overnight delivery, and one by regular mail. So you may be doing these things already, but if not, then these are things that you should definitely incorporate into your practice before you decide to commence a foreclosure. You want to have your system documented so that you can prove that you fall into one of these exemptions and are not violating the CFPB's pre-foreclosure review rule. I expect that the CFPB will enact their amendments by June 30th of this year. The reason they're not already enacted is because the CFPB promised to at least review the industry participants' comments. But these amendments will probably be announced as final, again, their final rule, if not today, then sometime by June 30th. And the CFPB's amendments do provide for a sunset date of August 31st of 2022. Small servicers are accepted from the pre-foreclosure review requirements. It will not apply to small servicers, which means a servicer with 5,000 or fewer loans, because the CFPB considers them as staffed with and using a high-touch model of customer service. So they expect the small servicers to already be going above and beyond what the CFPB is going to require here. So small servicers will be exempt. Also, small servicers are more likely to have their loans in their own portfolio, and they're not subject to investors' requirements. This was especially a problem during the foreclosure crisis back 10 to 13 years ago, because the investors were imposing strict timelines on the servicers to commence the foreclosure and complete the foreclosure, while the borrower might have been trying to negotiate for some form of loss mitigation. So that's the reason why, another reason why the CFPB is exempting small servicers from this pre-foreclosure review requirement. The CFPB wants to justify these new regulations by saying there are potential benefits to all parties. So borrowers obviously will have more of an opportunity to avoid foreclosure and foreclosure costs. The CFPB emphasizes that housing insecurity presents health risks. Health risks are often used to try to justify financial regulation these days, and the community will benefit from reduced foreclosures. As for the servicers and the investors, this is what the CFPB claims. Less foreclosures will reduce the foreclosure costs, that's obvious. However, it will incur additional costs for the servicers for mailings and inspections during the delays before foreclosure, property upkeep, paying taxes and insurance if the borrower isn't doing that, and the servicers will obviously have more cost of compliance for staffing reasons. The CFPB wants to ensure that you will be able to handle the volume of what the CFPB expects to be a wave of more loss mitigation requests prior to foreclosure. So this month, in 1 week, the number of calls to servicers from borrowers increased about 5%. That's in 1 week. The CFPB says the average call time is 7.8 minutes, which means some calls are way longer than that. But it's very important now to understand that the CFPB has put the creditor industry on notice that you must be equipped with trained staff to handle loss mitigation and the expected volume. It's labor intensive. The CFPB will not accept as an excuse all of a sudden we got hit with all these loss mitigation requests and we just didn't have the staff to handle it. The CFPB expects you to proactively be prepared, staffing, training, and be ready for when it hits. And the CFPB emphasizes that it's trying to ensure that all borrowers are treated with fairness and with equity. Finally, the American Legal and Foreclosure Network submitted comments. Probably other industry participants did also, but I want to share with you the AFLN's comments that it submitted to the CFPB after it reviewed the proposed amendments. The AFLN suggested first, exclude pre-pandemic defaults unless the borrower has taken advantage of a loss mitigation program. So if a borrower has been in default since before the pandemic and has not engaged in any loss mitigation during that time, why should there be a further delay in commencing a foreclosure while you're reaching out to the borrower further? The AFLN also suggested that the term financial hardship relating to the pandemic should be more clearly defined. So it shouldn't apply to every single borrower or almost every single borrower, but only those who can really justify that they've been financially impaired by the COVID-19 crisis. The AFLN suggested that the CFPB include an exclusion for reverse mortgages where the borrower is already deceased. That only makes sense. And what is the definition for an unresponsive borrower? Remember, that's one of the exceptions to the moratorium, is if you've got an unresponsive borrower. Like I said, the CFPB explained, 4 calls and 1 letter sent 2 ways without a response, but the AFLN wants a more expanded definition so that you are on safer ground in deciding that your borrower is unresponsive and you've exercised your reasonable diligence and you're now safe to commence your foreclosure. Yesterday, the AFLN reported that it had a follow-up call with the CFPB. The AFLN said in its report that its comments to the CFPB had an impact. Now that remains to be seen, but that's what the AFLN was led to believe from the CFPB. And also that the extension of federal moratoriums, this is Fannie Mae, Freddie Mac, VA, and HUD loans, were scheduled to be announced on today, June 24th. So watch the news for an announcement of the extension of the federal moratoriums likely today, so that those moratoriums will remain in existence for a period of time, but definitely enough time so that there will be no gap between now and or between June 30th when they expire and when the CFPB announces its final rule and its amendments. So that brings us to the conclusion for now. If there are any questions, here's my contact information. You're free to contact me at any time. I'll take 1 minute to try to read through some questions that may have already been submitted. So give me a minute while I take a look here. Okay, there's a question about small creditors. Where do they fail on this? Well, I think the amendments will provide that the smaller creditors, that's 5,000 loans or less, are exempt from the pre-foreclosure rule. That means you won't have to do the 4 calls and the letter sent 2 ways because the CFPB is assuming you're doing that anyway. That's the exemption for small creditors, but I believe the other parts of the amendments will not exempt small creditors, but it remains to be seen. We'll see when the final rulings are issued. And another question, can we review how this affects accounts in bankruptcy? Well, obviously in bankruptcy, due to the bankruptcy stay, you're prohibited from making an attempt to collect the debt. So, and obviously you're stayed from any foreclosure activity as well. So I think for the most part, the bankruptcy rules tie your hands from taking any action like that. But once it comes out of bankruptcy, let's say you get relief from stay, as we sit here today, I would expect that the CFPB would say that it expects you to reach out to your borrower at that time and explain the loss mitigation options it has, just like the pre-foreclosure rule for someone who's not in bankruptcy. We'll see when the final rule gets announced, and we'll probably publish that to our clients. So we'll stay tuned, but it should come very soon, and we'll know the answer at that time. I believe that's the last question, so that will bring us to the end of today's session. Thanks for joining. Again, my contact information is there. Feel free to contact me if you have any questions or if I can help out in any way.
Thank you, Larry. And thank you everyone for attending today's Weltman webinar. We hope you found this presentation informative. As a reminder, a short survey will pop up on your screen when the webinar ends, so please share your feedback and let us know what future webinar topics you would like to see. I would also like to share that we have a complimentary library of over 20 webinars that you and your team can view on demand. Our collection offers information on a variety of topics, such as bankruptcy, real estate, and the Bank Secrecy Act, to name a few. We'll send you a link to the library in our follow-up email. Thank you again for attending, and have a great rest of your day.